We're joined not just by Phil, but also Kathryn Rooney Vera, head of global research and chief investment strategist at Bulltick Capital Markets. And as I said here on set, Phil Orlando, a chief equity market strategist and head of client portfolio management at Federated. When you told us about some protection with puts, Kathryn, we knew about the coronavirus at that point, but that wasn't the only reason you thought you might hedge, was it, that you were suggesting back then? The market had run up quite a bit.
Absolutely, and I recommended the put option at a 325, 330 coming into this year. I noted high levels of complacency, and I would go against what Eamon mentioned and a couple other things. I think that, you know, it's a curious timing that over the past week you have both the coronavirus and you have Bernie Sanders, the front runner, and I think that, as I said to you a couple months ago, or over the course of the past couple months, Joe, I think that complacency had an expiration date. Whether the, you know, what portion of the correction was because of that front runner status, you know, it's hard to say, but what you can say is that healthcare fell, energy fell disproportionately, and I think that can be attributable to the rise of Sanders.
Point's been made, we were make it on the air but off camera, that supposedly Bernie is the candidate that Trump wants to run against. So, you know, if you don't believe Bernie can win, then why would you think that Bernie being the nominee would be a bad thing for Trump's election possibility?
Yeah,
but all bets are off. You don't know. Nobody knows whether Sanders could win or not.
Yeah, but that's why the put option is really in the money right now, and I'm telling my clients, Joe, to hold that sucker, hold that thing until expiration March 31. And if the market doesn't care when Bernie does a Sanders sweep March 3rd, if that's the case, then buy more. Buy the November 2020 put option, because there is a chance.
What are you doing, Phil?
So obviously the loss of life is tragic here,
right?
And we came into the year bracing for the potential of a 5 to 8% air pocket during the first half of the year, and we're basically there. So Monday, after we were down 5% from the top, we put 1% to work. So we took our equity overweight up from 5% to 6%. We elevated domestic large cap growth, which had been neutral. We took that to overweight. Those stocks are down 15 to 20% here over the last couple of weeks. The next move down, we think, is the 200-day moving average, about 2% below where we are here. We're prepared to probably put another % to work there. So we're going to keep scaling in, I think, lower, because our view is that as we look at the trajectory of this, as tragic as it is, we look at what happened with SARS, the avian bird flu, et cetera. We think,
if you're right, then why isn't the market discounting this more?
Because the market doesn't know. We don't know. There's absolute uncertainty here. One of the things that gives us a little bit of confidence here, Joe, I'm going to bring you in, Gilead and Moderna, in terms of the compounds that they're working on, they're in clinicals. Right. We're hearing that we may have some good news within a couple of months on that.
Therapeutically, we ought to be able to do something quicker than a vaccine. First thing we got to do is start get a lot more tests made. I think kits ready to go on that. But I was just thinking, you know, we were just talking about whether we'd even, to try to figure out the economic effects of even a small outbreak is hard to do. Right. You don't even have to assume we have it. Right. You don't have to assume we have a huge outbreak here. But health clubs. Right. What do you do with health clubs? I was thinking, I'd stop going probably. Movie theaters, restaurants.
No, wait, that's why you saw AMC sell off.
Think about it. I mean, it doesn't matter. You talk, and as far as the death goes, we know what the influenza. Right. The president made that point last night. 60,000 people a year die from that. We're nowhere near that globally yet with the coronavirus. All right, so if you're going to hold those puts, Kevin, I mean, it's nice to have protection, but you don't want to. It'd be nice to take profits, too, or else they didn't do you any good on the way down. I mean, so you'd never cover the puts, or are you just worried about more downside?
Yeah, I'd cover the puts if there's a noteworthy drop on March 4th, for example. But we'll have to look at the magnitude of that drop.
You're doing the election thing again. It's not coronavirus related. Okay.
Yeah. Look. I think that if we're talking exclusively about the coronavirus, Joe, I think it's time to start stepping in. I agree with your other guest. I think, however, that aggravating or exacerbating the current downside, which is principally due to the coronavirus, could be this political component of of a market that really has been utterly complacent about the risk of a candidate that is going to aggressively go after technology, energy, healthcare, and banks.
Okay. Excellent, Kathryn. Phil, so pretty simple what you're saying. Ease in as it goes down.
Scale in as we go
Scale in as we go down.
and try to monitor the trajectory of this as best we can.
We're down almost 10% today. If the futures were to open here, less than 100 points more to be down 10%.
A 200-day moving average, I think, is around 30, 40 or so on the S&P. So we could be there in the next day or so.
Phil, thanks.